Today, we're diving into one of the best trading strategies for bear markets, and they are called bear call credit spreads. If you're an investor looking to generate income even when the market is down, this video is for you. And be sure to stick around to the very end because I'll show you a bear call spread that I just entered yesterday so you can follow along and learn the step-by-step process. So, what is a bear call credit spread? A bear call credit spread is an option strategy for bearish or stagnant markets or stocks. You sell a call option close to the current stock price and buy another one with a higher strike price, both expiring on the same date. The goal is to earn the net credit, the difference between the sold and bought option premiums. This strategy is a win if the stock stays below the sold call strike price by expiration. You keep the net credit as a profit. But be cautious. If the stock rises above the bought call strike price, losses can occur. It's a balanced way to profit with controlled risk, ideal for bearish or neutral market views. Why are bear call credit spreads the best bear market strategy? Number one, this approach allows you to play the overall trend of the market, aligning your investments with the prevailing bearish sentiment. Number two, by following the method I demonstrate, you can achieve an impressive 85% probability of success, making it a highly reliable option. Number three, the strategy offers multiple avenues for profit. You stand to gain not only if the stock goes down, but also if it moves sideways or even rises a little bit. And number four, bear call credit spreads come with limited risks and rewards, providing a balanced risk-reward profile that is especially beneficial in uncertain market conditions. This combination of factors makes bear call credit spreads an unparalleled strategy for those looking to thrive in bear markets. Ready to roll? Smash that like button. Your click not only boosts our spirits, but also works wonders with the YouTube algorithm, helping us reach even more cool folks just like you. Thanks for the high five to our channel. Are you ready to turbocharge your investing journey? Weeble's got your back. Click the link in the description, deposit $100, and boom, up to 12 free stocks are yours. But why stop there? With Moomoo, grab 16 more free stocks. Keep them, sell them, profit from them. It's free money waiting for you. Don't blink, don't wait. Grab your free stocks today. Let's make investing exciting. How do bear call credit spreads work? First step, sell a call option. You sell a call option close to the current stock price or considerably higher depending on how much risk you want to take. Number two, you buy a call option. Here, you buy another call option with a higher strike price. Number three, you collect the premium. You receive a premium for selling the first call and pay a smaller premium for buying the second call. The difference is what's called a net credit, and that's yours to keep. What are the advantages of bear call credit spreads? One of the most compelling advantages is the limited risk involved. Unlike other trading strategies where losses can be substantial, the maximum loss in this strategy is predetermined and capped. It's calculated as the difference between the strike prices of the two call options minus the initial net credit received. This makes it easier for investors to manage risk and know exactly what they stand to lose right from the outset. Another key benefit is the ability to profit from time decay, a phenomenon known as theta decay. In a bear call credit spread, you're selling an option that you hope will expire worthless, allowing you to keep the initial net credit. As time passes and the options move closer to expiration, the value of the options you sold will decrease faster than the ones you bought, increasing the likelihood of keeping the net credit as profit. And lastly, the strategy offers flexibility. You can adjust the strike prices and expiration dates to align with your market outlook and the level of risk you're willing to take. Whether you have a mildly bearish view or expect the stock to remain stagnant, you can tailor the bear call credit spread to fit your specific expectations. This adaptability makes it a versatile tool for traders with varying market perspectives. These advantages make bear call credit spreads a balanced and effective strategy for investors who have a bearish or neutral outlook on the markets. Let's briefly cover the top 5 reasons for why the markets are bearish. Reason number 1, surge in treasury yields. First on our list is the alarming surge in treasury yields, and this is a tongue twister. The 30-year treasury yield recently jumped to 4.95% and the 10-year yield climbed above 4.8%. These are the highest levels in more than 16 years. High yields often signal that investors are losing faith in the stock market and moving towards bonds. Reason number 2 is political instability. Political unrest is another major factor. The recent ousting of the GOP speaker has led to market declines, adding to bearish sentiment. Reason number 3, rising volatility. The Chicago Board of Options Exchange Volatility Index, also known as the VIX, has surged by 15%, reflecting increased market anxiety. Higher volatility often precedes a bearish market. Reason number 4, strong US dollar. The US dollar index has surged beyond the 107 level, its highest point in the last 10 months. A strong dollar can be detrimental for US companies that rely on overseas revenues, thereby affecting stock prices. And reason number 5, overvaluation concerns. Lastly, there are growing concerns about market overvaluation. When stock prices are significantly higher than their intrinsic value, a correction is often imminent, contributing to a bearish outlook. Now, let's talk about what to look for in a stock when considering bear call credit spreads. I have some very specific criteria that I follow, and I believe this can help you too. Number 1 is the option expiration date. I like to choose options that expire within 3 to 14 days. I prefer weekly options because they offer the most time decay, also known as theta. The faster the time decay, the quicker you can potentially profit. Number 2 is option volume. Make sure the option you're considering has a volume greater than 300. High volume ensures liquidity, making it easier for you to enter and exit trades. Number 3 is the option delta. Look for options with a delta between 0.15 and 0.65. This range offers a balanced risk-reward profile, giving you a better chance of keeping the net credit. And number 4, average daily stock volume. Aim for stocks with an average daily volume greater than 1 million shares. High stock volume indicates strong investor interest and provides additional liquidity. By following these criteria, you can increase your chances of executing a successful bear call credit spread. Remember, the goal is to maximize profit while minimizing risk. Now, let's do a real-world example. Here's the Patreon trade alert I sent out yesterday. We're now in my Discord, and let's go over that trade alert. So we sold the Amazon bear call credit spread. We sold the $132 call. We bought the $133 call. This is small account friendly, and that's because of the limited risk. Our expiration date is October 13th. The delta we sold was the negative 0.14. Our break-even price is $132.11, and our maximum profit is $11. Maximum loss is $89, and that's per contract. Our profit odds are roughly 86%, and we know this because the delta is negative 0.14, and our 8-day ROI works out to 12.35%, which is a really good ROI over 8 days. Now, the reasons: the stock is expected to be lower than the break-even price at expiration, our strategy, and then we've also got a caution here, and then we've got the chart. And for analyzing the chart, let's look at the chart closely. You'll notice arrows pointing in certain directions. These arrows suggest a trend or tendency for the stock to move in that direction. However, it's important to note that these are not guarantees. So if we look at the chart right here, these are the arrows I'm talking about, and typically if we've got an up arrow, the stock is going to go sideways or up after that arrow. You'll see that's holding true. The down arrow, it's typically going to go down or sideways. However, we want to ignore the arrows whenever we're right next to an earnings date, and that's what this is right here. So you can see we recently had a down arrow here at the high, and then we picked up another down arrow a couple of days ago. So these are good signs that Amazon is likely to continue going sideways or down. Now let's look at a couple other things. Earnings season's caution, we just talked about that. And then a market update on Amazon. Amazon shares are currently experiencing a decline. This is happening in the context of a broader market downturn due to increasing yields. Additionally, Ofcom, the UK's communications regulator, is reportedly advocating for an antitrust investigation into Amazon and Microsoft's cloud computing market share in the UK. And my takeaway: based on the current trends and market conditions, I do not anticipate that Amazon shares will close above 132 on October 13th. This would require an almost 6% upward move, which seems unlikely given the current circumstances. So that's the trade alert. This is why I entered the trade. And now let me go ahead and show you just how easy it is to enter the trade and what we're looking for. And we'll do that on the Thinkorswim platform. We're now in Thinkorswim, and you can see the chart's a little bit bigger here, so that's the down arrow that we're talking about. We also have this yellow line, which is the point of control, and then at the bottom you can see a couple of my custom indicators. We've got the momentum dream indicator, one that I love, then we also have our buy sell indicator, and we're currently red on red. Now ideally I would have preferred to jump in at this one when we just went red on red and we picked up a sell signal. This is a little deeper than I normally like here on our momentum, but I still took this signal. So now let's look at the option. So all I do is come over here and click on trade, and now I'm looking at the option chain for Amazon. We've got the 13th of October pulled up. Our left-hand side is calls, and let me clear this out so we can build it as we go. And what we want to do is we want to look for about a 0.15 delta. So here we can see 0.16, and this is our delta. So we're going to come over here and we can see this is the 132, which is the same one that I have. So we're going to sell that, and then if you use the control function inside Thinkorswim, you can add another position, and now we're going to buy the 133, and here that is. We just created this, and this is actually a better position than the one I opened yesterday, and we're looking at a 0.14 credit. Next, we can click on confirm and send, and this gives us our order confirmation dialog box, and here's what we're looking for. A maximum profit of $14. Our maximum loss is $86 per contract, and whenever I'm doing this, I always want my maximum profit to be roughly 10% or better than the maximum loss. So here you can see we're beating that, and then all we have to do is hit send on this. Now, a couple of things. Thinkorswim, TD Ameritrade, Charles Schwab, they do charge commissions or fees on options. You could do this same trade on Robinhood, which is what I did, and then you have no option fees. Either way, it's up to you, but you'll save a little bit of money with Robinhood. But I've shown this on Robinhood before, and I wanted to show it on Thinkorswim so you can see both ways. But this is how easy it is to enter the trade. And then if you did want to enter, let's say you wanted to do 5 or 10 of these, you just simply add up your number of contracts right here, the quantity, and now when we hit confirm and send, you're going to see the same thing. Our maximum profit would be $140, our maximum loss would be $860, and that's how you do the credit spreads. To wrap things up, bear call credit spreads are a powerful tool for investors navigating bearish or flat markets. This strategy offers a balanced risk-reward profile, making it an excellent addition to a diversified portfolio. Remember, the key to success lies in following specific selection criteria, such as option expiration dates, option volume, option delta, and the average daily stock volume. These guidelines will help you execute this strategy effectively. Now, if you're interested in real-time trade alerts, I invite you to explore my Patreon. Want to take your trading to the next level? Check out the free trial link for my TradingView indicators below. And don't miss out on the free stock offers from Webull and Moomoo, also linked below. Your likes and subscribes fuel this channel, and I'm excited to bring you even more valuable content. Thanks again for investing your time with me today. Applying the bear call credit spread strategy could be a significant advantage in your trading, especially when the market is less than bullish. I look forward to sharing more insights with you. Until next time, peace.